me introduce myself. I'm Bob Glauber. I'm a fellow at the Center for Business and Government and a lecturer here on the Kennedy School faculty. And I am distinguished among the people here at the table as first I am the moderator, and I assume I've been chosen to be a moderator rather than a speaker because I don't know very much about this subject, and they do. I want to thank the Real Estate and Urban Development Forum for organizing this event. It is a really quite remarkable event, and I think all of us are going to learn a great deal. I want to just say one or two words by way of introduction. The various panelists here, I think, represent a wide variety of approaches to the community development banking process, all the way from the South Shore Bank and the Boston Bank of Commerce, which are sort of new structures, to the first community bank, which is a bank within a bank, the Bank of Boston. But for all of them, I think what will be interesting is to hear their answer to sort of first, what is the problem that's being solved here? And second, to the extent that it is their view that something new needs to be done, why is it that the market and existing institutions haven't succeeded in solving this problem? Having said that by way of introduction, I hope so that there'll be enough time for everybody to be able to ask questions, that the panelists will limit themselves to something on the order of 5 to 7 minutes, and that way we'll have ample time for what is now a rather large audience to participate fully and ask their questions. So, without further ado, I'm going to go down pretty much the order on the program, and our first panelist is Ms. Mary Houghton, who, as you know, is president of the South Shore Bank. She probably holds the record for having come the furthest for this. She is currently president of the South Shore Bank, the Shore Bank Corporation, which she co-founded in 1973. In addition to overseeing South Shore Bank's operations, Ms. Houghton is a member of the 4-person management team. Shore Bank subsidiary, the South Shore Bank, has, as I'm sure most all of you know, served as the model for President Clinton's community development banking proposals, and currently has over $160 million in assets. Shore Bank has been instrumental in organizing community development initiatives in such diverse places as Arkansas, Michigan, and Poland. So, Ms. Houghton, won't you begin?
Thank you. I thought I would try in 5 minutes to summarize sort of what strategy, what scale, what impact, and what are the differences and similarities with this idea of a community development bank holding company with the conventional banks and the nonprofit development institutions, and what are the shortcomings of the Shore Bank model. That's about 30 seconds each. The strategy that the people at Shore Bank are following is to use a bank holding company to integrate the delivery of credit, equity for both real estate and business, public subsidy and private grants, and to use those resources to target one small geographic area where it will attempt to both create and support market forces through the delivery of concentrated resources. That's what we do. We try to use the credibility and leverage of a bank to both win resident trust, recruit and retain talent, and to maintain independence as a professionally managed permanent development institution. And the bank holding company model allows us to come close to working on that kind of approach over a very long period of time. The problem is that not enough resources are invested in inner city urban communities and rural small towns, mainly because the size of transactions and the cultural differences between residents of those areas and the bankers are pretty broad. To give you an idea of what scale and impact the community development bank that is in Chicago has achieved, between its 5th and its 15th year, it averaged about $13 million a year of new development investment in South Shore. Between its 15th and 20th year, that number had gone up to $19 million a year. During that period, it has provided financing to rehab 1 out of every 3 units of apartment building housing in the neighborhood, and it has gotten a ratio of 5 units of rehab on an unsubsidized market rate basis for every 1 unit of subsidized publicly funded housing rehabilitation. The simplest way to say that there's been an impact in South Shore is that there are no vacant lots in the apartment areas of South Shore today, and all of this has occurred in a very concentrated area, 1.5 miles by a mile, 80,000 people. We've got 5 years of experience in Austin, 5 years of experience in Arkansas, 1 year of experience in the Upper Peninsula of Michigan, and in the latter 2 places, instead of having the goal of community development, we've had the goal of small town enterprise development. I made a list of what I imagined were the differences between what we do and what banks do, and between what we do and nonprofit development institutions do, in order to try to lay the groundwork for a vigorous debate. On my list of differences between Shore Bank and conventional banks, I have that we're in a different business. We're in the business of community development. That the non-credit components of what we do are as important or more important than the credit components. That we are not maximizing return for our shareholders, that we are very small compared to most banks, and that development outputs are central to our business and our survival. We specialize in small transactions. How we're different than the nonprofit sector is that individual residents are our customers as opposed to being project-oriented. We're regulated, and we have a bottom line because we must be self-sustaining. Similarities with banks. We both manage risk in order to yield no more than about 0.5% net loan loss ratio. There are no special rules for Shore Bank. It's a regulated commercial bank like every other bank. It seeks market niches, and the targeting that it does is a technique which has the effect of reducing the information costs of the transactions that we finance. Similarities between us and not-for-profits are that both Shore Bank and every not-for-profit that's really serious about community development requires permanent capital in order to be professional, to retain talent, to pursue multi-year agendas. We're like not-for-profits in that we have a comprehensive agenda, not just credit, not just housing. We're focused on economic benefits to low-income people, and we are kind of a specialized intermediary the way they are. Some of the shortcomings of Shore Bank as a model are that it itself has had an over-reliance on housing, needs to be doing more in enterprise development and labor force development, and that it probably hasn't paid as much attention as it should to what is really a different task of resource generating for the nonprofit activities that it is associated with. As a model, I don't think Shore Bank works in a totally low-income community. It needs credit-worthy borrowers in order to have an effective banking strategy. Can't touch the needs of education and of children. And its culture supports a kind of emphasis on financing as opposed to information delivery. And I think that if one really wants to create jobs, affect the labor force, revitalize communities, that the transfer of effective information is probably more important than the transfer of financial resources. So that's my introduction. Thank you.
Thank you very much. Let me next call on Mr. Ron Homer, who is the chairman and CEO of the Boston Bank of Commerce. He's been chief executive of this bank since 1983, a year after the bank was founded. Since then, the bank has grown from $10 million in assets to approximately $90 million in 1992. Boston Bank of Commerce is New England's only African-American-owned financial institution. Prior to joining the Bank of Commerce, Mr. Homer was executive vice president and chief operating officer of Freedom National Bank of New York from 1979 to 1983. During this time, Freedom became the largest and most profitable African-American-owned bank in the United States. Mr. Homer is director of the New England Telephone Company and several other corporations. He's past president of the National Bankers Association and the current chairman of the steering committee of the American Bankers Association Center for Community Development. He was born in 1947 and raised in Brooklyn, New York. Received his BA from the University of Notre Dame, his MBA from the University of Rochester. Mr. Homer.
Thank you. That's longer than my comments, but in any event, I think I'll step back and try to answer your original question rather than duplicate what Mary Houghton said, because much of what we do is similar to South Shore Bank. You asked the question, what's wrong and what are we trying to fix? Let me start out with, I got involved in banking actually in the late 60s, early 70s as a frustrated social worker. I had gotten a degree from Notre Dame and had decided I wanted to take that degree and do something to improve the quality of life in the community that I had come from, or communities like that, and and at that time there was fresh after the Watts riots and riots around the country, and there was a lot of discussion about rebuilding America's cities. And I was inspired by Bobby Kennedy and Martin Luther King, who were both shot in my senior year, and decided if they lay down their life for improvement, I could at least do something with my degree. And I think that's part of the start of what we're trying to fix. Since the riots in the 60s, there's been a rapid disinvestment from our cities. In fact, when I go back to South Bend, Indiana, where I started out from, instead of things getting better, it's gotten worse in that area. And I thought maybe it got worse just because I had gained in age, but I did have pictures going back where we lived, and in fact, it has deteriorated. And I think something happened after the riots. Generally, most communities, the backbone of America, small communities, are their merchant class and working class families who own their homes and take a stake in the community. If you, I live in Lexington, Mass right now, and I don't think I've ever been to a school board meeting or a town committee meeting or a town meeting. I basically work in Boston and sleep in Lexington, but the schools run fine, the town runs fine. There's not a lot of debris on the streets, and that's because we have Rotarians and the local Chamber of Commerce and all of those people who do business in town make sure that the town runs smooth. They watch the city fathers and they complain about anything that even looks out of line, and they're really the backbone of that community. Now, surely the economic backbone may be the dollars that are brought in by Lincoln Labs and Raytheon and the people who work there and take their money and spend it, but that money recycles through insurance brokers and real estate brokers and the little coffee connection and the little boutiques where people shop, and money is recirculated in the community. In the 70s, after the riots, the existing merchant class in many of our cities, who are predominantly the previous ethnic group who lived in those communities as blacks migrated, they left in a hurry because they were fearful of their investment, and they cashed out quickly. Ordinarily, what would have happened through this migration would have been some succession in them. They're selling their businesses to someone locally, apprenticeship programs where people worked after school and got to know the business, and there would have been some transfer, but there was a mass exodus of these businesses because of the fear of the riots. When you couple that with at the same time, there was a dramatic increase in government support, but primarily in social services. So there was capital coming into this community, but it was in the form not of to buy these businesses and to start a dry cleaners establishment or to start a bakery or an insurance brokerage firm, but it was more likely to be in some type of social service program designed to meet the Kerner Commission report and other perceived ills in the community. Also, affirmative action started to take hold, and many of the people who had been previously denied access to jobs in the IBMs and the Xeroxes and the Harvards, et cetera, the talent within the black community took advantage of the open doors in new areas. So you had three factors working simultaneously. One, a rapid flight of the merchant class who existed in these communities. Second, new capital coming in, but mostly in the form of transfer payments or support mechanisms. and third, the talent base that could have been the entrepreneurial base moving out of the community to take advantage of newer opportunities. And it's been my experience over a period of time that those initiatives have drained the community of available resources. In many instances, it's much easier to raise money and to get a grant to start a drug treatment center than it is to get a loan from any one of our banks to start a new business in the city. And I could go on and on over the various inequities and how much difficult it is to get capital into these cities, but there is a form of economic discrimination that's taking place which reinforces the lack of capital going in. And so I think one of the tasks of a community development bank is to try to stem that tide. Our bank is a net importer of capital into the community, probably one of the few. I think even if you looked at tax receipts, most of these communities don't get their fair share of taxes back into the communities because much is stripped off in defense and other activities. We're probably one of the few importers of capital into the community. Secondly, we're as Mary Houghton said, we're a constant force whose principal focus is the development of a merchant and middle class in these communities. That's our primary mission. As a bank, we only make money to the extent that we create homeowners and businesses and help people invest their dollars. And so that's our principal mission and focus. A good example of what that means to a community is a number of years ago, we took on the task of rebuilding redeveloping Parcel 18, which is in the middle of Southwest Corridor, where the government had put $600 million in a new transportation rail line, but had over 20 acres of vacant land that had been cleared out by urban renewal and to make way for a highway. And over a 20-year period, nobody had put any private dollars into that. And we took it on as our mission to start the development process. It took us 5 years with many battles with the state legislature and a lot of lobbying with governors and mayors. We've gone through two governors and a mayor and a half to get this done. But we finally got the registry of motor vehicles to move into that area, which will bring 900 jobs. We now have a site that's ready, zoned, available to be built, lower land cost than any competing site, and we're trying to get the Longwood medical facilities to move into that. But even with a $10 a square foot advantage over competing areas, many institutions won't move their resources into this community because of the perception we're on a railway line. And even Bank of Boston, who financed the construction loan on the registry, we had to get a special act of the legislature to have a 15-year lease that would fully amortize a permanent mortgage, which the Carpenters Union built because they wanted carpenters work there. And then Bank of Boston agreed to give us the gap financing with an ironclad takeout for $26 million and said, look, we're putting $26 million into Roxbury. Well, it took us 5 years to build a platform for that $26 million to come in, and unless we had put the toil in, we don't think the $26 million would have ever been there. And so I don't want to take up more of my time, but that really highlights the type of things that a community development bank can do, and that is to lay the groundwork and the infrastructure in which additional private investment can come into these communities. And without some concentrated work on the behalf of somebody in doing this, I think we'll just continue to see an erosion of our cities, and so that's what we're trying to address.
Thank you very much. I'd next like to call on Mr. David Parrish, who's currently Vice President Director of Housing and Community Investment for the Federal Home Loan Bank of Boston, where he's responsible for the development and administration of the bank's special housing and community development initiatives. Before joining the Federal Home Loan Bank of Boston, David was Director of Research and Development for Fannie Mae in Washington and Director of the Division of Research and Evaluation for the Neighborhood Reinvestment Corporation, which is also in Washington. He has a degree in political science from the University of Rochester and a master's degree in environmental design from Yale University. Mr. Parrish?
Thanks. I think I probably had better start by talking a little bit about the Federal Home Loan Banks and what they are, because it's really quite a different organization than anything else that you'll hear about today. The Federal Home Loan Bank, the Boston Federal Home Loan Bank, is one of 12 Federal Home Loan Banks scattered around the country. We're a central wholesale bank. What we do is loan money to other financial institutions. The banks were founded 60 years ago after the Depression as a way of getting capital flowing around the country, primarily into residential finance. We're federally chartered, but we operate as a private corporation with a board of directors made up of a combination of public interest directors and directors from the financial industry. We are capitalized to a large part by stock that member institutions buy in the Federal Home Loan Bank, which they in turn receive a dividend on. The world for the Federal Home Loan Banks and for a lot of other institutions was turned upside down a few years ago when FIREA was passed, the Federal Institution Reform, Recovery, Enforcement, and God knows what else Act. And it had a profound effect on the Federal Home Loan Banks. We're still working that through, and now I think another wave is probably about to hit us. In terms of the things that I would highlight in terms of FIREA, one is it ceased a regulatory role for the Federal Home Loan Banks. Prior to the passage of FIREA, the Federal Home Loan Banks were also a regulatory agency. We regulated the institutions that we also lent to. It was wise, I think, to separate those functions. The second thing that it did was expanded the potential for membership in the Federal Home Loan Banks and allowed any federally insured financial institution to join the Federal Home Loan Banks. This has had a profound effect on the system in that it's opened up membership on the part of commercial banks and credit unions, again, any federally insured financial institution. The New England Bank has always been a little bit different, probably because it's in New England, and New England's always a little bit different. But it's had a large percentage of what we call voluntary membership, which means that they are banks that have joined the bank to use its services and are not required by statute to be members of the bank. But for many of the other banks around the country that were members of the Federal Home Loan Bank, they were in fact required to be members. I think this orientation gave us an advantage in terms of attracting new memberships into the Federal Home Loan Bank. And since the passage of FIREA, we have now 100 new members of the Federal Home Loan Bank of Boston, many of which are commercial banks. Ron's Bank, the Boston Bank of Commerce, is now a member of the Federal Home Loan Bank. Through the Bank of Boston, Rhode Island Hospital Trust, the Bank of Vermont. So a lot of the commercial banks, a number of the credit unions, some additional savings banks and so on have joined the Federal Home Loan Bank. And now, as I understand it, the South Shore Bank has joined the Chicago Federal Home Loan Bank. So it's an interesting merging of interest, I think, that's going on. The third thing that happened was it had added a number of new programs in the list of tools that the Federal Home Loan Banks had. One is called the Community Investment Program, which is really just a lending program where we can provide funds to member institutions, essentially at our cost of funds, to do both housing and commercial economic development. I'll talk a little bit more about that later. The Affordable Housing Program, which is really a unique approach in which Congress said to the Federal Home Loan Banks essentially that they were to set aside a percent of income starting at 5% and going up to 10%. It will be 6% next year and 10% after that into a subsidy fund, which we then use to help support affordable housing projects around New England. And also organized advisory council, again, of primarily nonprofits, public interest directors for the banks to advise us how these programs would be run. The Boston Bank, I think unique in the system, established a fourth program of its own called the New England Housing Fund. And although it's called the Housing Fund, it really is a fund that can be used not only for housing but for community economic development also, which has been quite popular. Just to give you an idea of what's happened with these programs, since April of 1990, the Boston Bank has committed a little over $500 million to its member institutions throughout New England, a number which I think really has surprised all of us at a time when the New England economy has not been particularly vigorous, as you all know. About 40% of the membership of the 350 roughly members of the Federal Home Loan Bank have requested funds under one of these three programs at this point, about 142 banks. It's resulted in funding probably for about 4,700 units of housing. In terms of the future for the federal home loan banks and their role in community development, the banks are, as we say, in play at the moment. They are very much the subject of study in Washington. The federal home loan banks are currently being studied by 10 organizations. There was legislation passed last year and required essentially everyone who does these kinds of studies to do a study of the Federal Home Loan Bank also. It's clear that there's going to be an increased emphasis on the broader area of community development and not just housing. Up to this point, we have traditionally been a housing bank, but most of the language, as is happening in the country as a whole, is moving more and towards the more comprehensive idea of community development. And that's something that we expect will be more and more a part of what it is that we're involved with. Again, a number of our programs, the regulations have recently been liberalized to allow us to use the funds through our member institutions in community economic development in addition to housing. Again, with the new membership, banks like South Shore, Boston Bank of Commerce, various commercial banks, it really opens up the potential, the possibility for federal home loan banks to provide funding into some of these areas where we haven't traditionally been involved. There are other tools, things like letters of credit, which might be interesting to talk about at some point. It's based upon the AAA credit rating. The federal home loan banks are one of the few institutions in the country that maintain a AAA rated letter of credit, so that can be a very powerful tool, I think. Just a couple of changes in closing. One is we have recently at the Boston Bank done something that has not been done in the system before. We have begun to lend directly to the housing finance agencies in New England. We thought we were prohibited from doing that. A sharp lawyer found a phrase in one of the statutes that in fact allows us to do something we never thought we could do. Well, we think it allows us to do something we've never been allowed to do. We're doing it anyway. But I think it does raise the whole question, and it's something that we're approaching very cautiously about the possibility and the advisability of an agency such as ours lending directly to financial intermediaries other than the traditional commercial banks, savings and loans, and so on. In closing, I'd say that the primary thing that we've learned at the Federal Home Loan Bank is that although the financing is important, that in fact our primary role is an educational role, that many of the financial institutions aren't fully equipped to do community economic development lending. It is a different field, it can be a complex field, and I would guess that at this point we're probably spending the great majority of our time not so much in writing loans and dispersing money, but dealing with the whole question related to the educational concerns of institutions as they begin to move themselves more and more into this area.
Thank you very much. David, in the interest of full disclosure, I should tell you that I was the official at the Treasury Department primarily responsible for FIREA.
It was a great act.
You're a consummate gentleman. Our next panelist is Ms. Gail Snowden, who is president of the First Community Bank, which is a subsidiary of the Bank of Boston, where she is responsible for the bank's network of 15 inner-city neighborhood branches and its community-based lending operations. First Community Bank is a multi-state business unit geared to meeting the banking and credit needs of the Bank of Boston's inner-city residents and businesses throughout New England. She served as the advisory committee chairperson and president of the National Urban Bankers Forum, director of Freedom House, director of the Federated Dorchester Neighborhood Homes, director of Bay State Skills Bureau. She's a graduate of Harvard College and holds an MBA from Simmons College. Ms. Snowden?
Thank you. I have an awful lot in common with Ron. When I graduated undergrad, I also had intended to become a social worker. So it is great after 25 years at Bank of Boston that I can be a social worker within the context of a large financial institution. I grew up the child of community activists, so I'm sort of different within Bank of Boston. My parents worked in Roxbury from 1949 to 1985. So I kind of absorbed a lot of things through the pores that I didn't know I was getting. And now that I'm running this business, it's wonderful to be able to tie your professional life with your values and ethics. With one of the 25 largest commercial banks as our parent institution, I may bring to this discussion a perspective that is somewhat different from my fellow panelists. However, what we do share is a common concern for inner city communities, for the individuals and for the institutions, and a commitment to the revitalization of those communities. Our experience in community development lending demonstrates that very large commercial banks can find innovative ways to provide banking services for economically distressed communities. I think that where institutions have not been established in a community, I would support the creation of de novo community development banks. But where institutions such as ours exist, or Shore Bank or BBOC, we think the Clinton administration should be looking for ways to bolster our capacity through additional capitalization, regulatory relief, and perhaps expanded bank powers, instead of creating new institutions. Joe Kennedy pointed out recently that the amount of lending that can come through community development banks is going to be small in comparison to what the banking community can do if the community sets its mind to it. We agree, and the experience of First Community Bank supports that concept. First Community was launched in 1990. There was a growing concern among community and government leaders here in Boston that banking practices did indeed contribute to racial disparity in the mortgage market, and that banks were leaving Boston's minority community underserved for other important credit and financial services. At that time, we decided at Bank of Boston to use our own resources to do more than business as usual, so that we could better serve the needs of low and moderate income persons in our market. How do we fit into Bank of Boston's overall structure? We are run as a separate marketing and administrative unit within the framework of our conventional retail bank. We have a centralized management and lending group. We have a separate marketing focus, and we have introduced and continue to do so an innovative set of affordable banking products. We have grown from our original 7 branches in 1990 to 15 branches, 12 here in Boston, 1 in Providence, 1 in New Haven, and 1 in Holyoke. We have roughly $300 million in deposits and a staff of 160 people. How does our program work? What makes it work? A few of the must factors are senior management that is willing to allocate the resources. When we were started in 1990, it was a tough time here in Massachusetts, in fact, in the whole region. We were one of 2 projects within the bank that wasn't Invest. So that senior management and the willingness to do that made a difference for us. We have extensive local outreach that works with the local media, community groups, the churches. We have special educational programs on personal banking, home buying, and small business. So we do we're a blend of what the other panelists have talked about. We do think that educational piece is very important. While these factors enable us to create a sense of community banking through our small bank within a bank, having a large bank behind us means an even broader range of services are within reach for our inner city customers, and access to financing for credit-worthy large-scale projects is available. A few things that we have worked on. We work with many intermediaries and public programs to create partnerships. Among those are the Massachusetts Minority Enterprise Investment Corporation, which is a multi-bank owned for-profit community development corporation. We are a co-founder and charter member. Ron is also a member. We have invested $1 million in MEIC to help create a larger pool of locally available equity capital, and we also provide a $3 million line of credit. Our president, Chad Gifford, serves as the chairman of MEIC. We also provided a $250,000 line of credit to the Boston Small Business Loan Fund, which reaches those microloans, ones that are very difficult for banks to do, between $1,000 and $20,000. This is a program sponsored by the city's neighborhood economic development agencies, And these loans are put together with the support of local community development corporations in targeted neighborhoods. We also put an emphasis on direct technical assistance by our own staff, primarily the lending staff to small businesses and would-be owners. We hold seminars and workshops in English, Vietnamese, and Spanish, covering such subjects as how does a bank look at a borrower, how to fill out the credit application, and basically trying to demystify the process. Ron has already mentioned our participation in the Ruggles Center project, the largest minority-owned commercial development in the country, and the largest commercial development in the history of Roxbury, which, as Ron has said, will create many, many jobs. And we have provided the $26 million construction loan for the first phase of this project. Another example was on display last week when Secretary Henry Cisneros visited our Codman Square branch in Dorchester in the renovated Lithgow building, which we helped to finance. If you go through many inner city communities, you'll see that there's usually one building that if you could just rehab that building would make such a difference in the community. And usually they're these odd-shaped buildings that are on a corner like this, but they're the first thing you see. In Codman Square, it's Lithgow. In Grove Hall, it's the Silver Building. In Dudley Square, it's the Ferdinand's Building. If you can renovate these buildings, you will see a difference in the community. And in fact, since the Lithgow building was renovated, there have been 38 new businesses that have opened in Codman Square. Any national community development banking program should encourage existing institutions that aren't active in community development to do more so. There are many flexible bank regulations in the Bank Enterprise Act, known as the Greenlining Bill, enacted in 1991. This innovative legislation allows banks to pay reduced insurance premiums on deposits held in Lifeline or basic banking accounts. It gives banks credit on deposit insurance premiums for loans to distressed communities or branches operating in these neighborhoods. Unfortunately, Congress has yet to appropriate the money for the FDIC to implement this legislation, but we need many more incentives along these lines to encourage traditional commercial banks to do more in communities. So our experience underscores the importance of encouraging the development of more than one model for community development banks. A national network of small, thinly capitalized de novo community development banks should not be the only answer. We would hope that the Clinton plan would also seek to bolster, through additional capitalization and regulatory flexibility, the already existing operations. This would allow all of us to increase our volume of lending in areas of need and to explore alternative community investment strategies. These institutions are likely to have experience in stitching together the partnerships, all the varied, complex layers of financing, public and private, state and local, as well as federal, that is needed for small business lending or real estate development projects. In closing, let me emphasize that we welcome the attention shown by this administration in this area. While the issues underlying community revitalization are much deeper than credit needs alone, we feel that by singling out community development banking so early, President Clinton is signaling his unmistakable intention to provide new federal resources to spur economic revitalization. And we want to be a part of this process. Thank you.
Thank you very much. Our final panelist is Mr. Henry Morgan, who was formerly the Dean of the Boston University School of Management. He is one of the original investors and directors of Shore Bank, and a leader in the socially responsible investment movement. He's held posts as manager of human resources at Polaroid and was president of KLH Research and Development Corporation. Now serves on the boards of over 30 companies, not the least of which is Ben & Jerry's. Morgan has been active in the past 30 years in helping companies play the appropriate role in fostering social change.
Thank you, Bob. First of all, I never intended to be a social worker, and I never intend to be one. I actually went to MIT and got an appropriate doctorate in solid-state physics, which is important. You can laugh at it, but what I learned most was from quantum mechanics, which says that all things are related, and you can't just fix one thing. and that's important in community development. You can't fix one thing. The moderator raised the issue of solving a problem and alluded to what is the problem. And let me try to state it. In general, the banking industry has not acknowledged that there is a problem. And my analysis of the problem is that the present banking system fosters gross inequities in access to capital for a large proportion of the population. In effect, this population, both urban and rural, have been disenfranchised. That's my statement of the problem. But let me emphasize further that community development banking is not merely the extension of credit. Community development banking, in my view of credit, is that you wait for somebody to come in and ask you to borrow money, ask you to lend money, or else you kind of go out and find people looking for money. And I think that community development, large development, little banking, requires an active participation in creating solutions to systemic problems, not just the extension of credit. Mary didn't mention the Shore Bank subsidiary CityLands as strongly as I would. CityLands is a for-profit development company which is allowable under the One Bank Holding Company Act. Matter of fact, I think we were the first ones in Chicago to take advantage of that, and when the Fed granted us permission to do that, they were worried about what Citicorp would do if they got this idea, so they limited the amount of capital that we could put into the for-profit development company to, I think, 15% of our capital, so that Citicorp wouldn't become Olympia, New York. Let me speak as an investor. The four that have spoken have been the active participants. I'm in this as an investor. I invested in Shore Bank nearly 20 years ago. I invested in Southern Development Bank Corporation about 6 years ago, I think. And essentially all my assets are invested in what I consider socially important ventures. This is not kind of a little slush fund. This is, all of it. And my wife doesn't realize it at times, and I don't tell her. But the reason I did it is because I believe strongly that to do adequate development, it has to be on a sustainable basis. And the private sector equity capital organizations are the most, when run right, are the most consistent, sustainable source for social change. You cannot rely on legislatures which change every 2 years, or presidential offices which may last only one term these days. I hope not, since Mary and I served on the board with Hillary in Arkansas, and we have some debt of gratitude to the Clintons. But I think that the private equity capital market is the most important source for providing sustainable development. In order to do that, you have to change the concept of the bottom line to a two-part bottom line. Early on, we had a director who was from the Cummins Engine Foundation, and he wrote a wonderful memo to us about our 3rd year of operation in Chicago, emphasizing that we had to balance development and profits. And our goal in Chicago for 20 years has been to get the appropriate balance between development and profits. If we make too much profits, we're not doing enough development. If we do too much development, we're not making enough profits. And you need the profits. I haven't seen a return on my money yet, but I hope this year, right? We've got a dividend. But I think it's important that everything we do in this area emphasize the dual responsibility of development and profits. I'm also encouraged that more businesses than just banks are acknowledging a multiple bottom line, that there is a bottom line which goes beyond profits. It's some responsibility to various stakeholders, so it's not just the banks. Let me just close a little bit and say that I think that a number of the institutions here, the Boston Bank of Commerce, First Community Bank, are on the right track. we're all in this together. I think we're each doing it differently. Each community is different, and you've got to tailor your development activities to the community that you're involved in. Mary mentioned Arkansas, Poland. I think you got some people in Bulgaria, if I'm not mistaken. We're working on a development of the first ecological sound development bank in Willapa Bay, Washington, which is something SureBank will be launching soon. So it's a matter of what is the development needs of that community and how do you balance profits and credit and development activities with that community's needs. Let me be a little irreverent here and say that my problem with the political conservatives is they believe that being poor is a result of a character flaw, so there's really nothing you do about it. And the problem with the political liberals is they want to help the poor. And to do that, you have to make sure that there are programs which keep enough people poor. I'm committed to not having poverty. It seems to me that what we're talking about is using an economic system not to sustain poverty, but to help people help themselves out of poverty, and I think that's what the community development banking system is all about. Most large banks, present company accepted, think that the CRA is a pain in the butt. I had a meeting this week with a branch of a large West Coast bank who just want the local banks not to give them any exposure because when they want to acquire some other bank, they can't have an embarrassment. So the CRA activity is to keep us from being embarrassed. Very few banks see the Community Reinvestment Act department as a profit center. It's always a cost center. And until community reinvestment and community development is recognized as both an opportunity for development and an opportunity for profits, we won't get anywhere. Thank you.
Well, thank you very much. I'm now ready to throw the floor open to questions. I believe the appropriate process is to use the microphones, or is that not necessary? Yes. It is necessary. So if you will go over to the microphones, and when you ask your question, if you just identify yourself and your affiliation, while you're going there, let me start with a question, assume the rights of the moderator. Gail Snowden and Mary Houghton and all of the panelists really explicitly or implicitly raised this issue of the importance of existing institutions versus new institutions. Existing institutions have been thought to play a role in community development. They are encouraged to do so through the greenlining law, to which you referred. That's the carrot. There's the stick to which Henry just referred, and that's the Community Reinvestment Act. On the other hand, the Clinton administration has made a great deal of new institutions, these community development banks. I just wonder what our panelists, any of them, feel is the appropriate balance and appropriate role for these two different approaches, new institutions versus making existing institutions work better.
I'll give you my answer. Is that there ought to be a competition in this society between existing banking institutions, new institutions, and whoever has the capacity to deliver the most outputs in communities and who has the most passion to produce at a high impact level will, I think, if rigorously monitored over time, succeed the best. McDonald's looks for people with ketchup in their veins. I think community development banking efforts should look for people with development in their veins.
Yeah, I would just add one thing. I agree with that, that we shouldn't really talk about whether it should be new or old, but to put the best players on the field. I would hope that to the extent that capital is going to be put on the table, that we would look for those that had the entrepreneurial spirit, the capacity, and could hopefully do something, either proven that they're willing to do something different and it's working, or have a good plan for doing something different that's working. Now, what I do disagree, I've served on a panel with Terry Murray about 2 months ago, and he is against community development banks, and he said the reason he's against it is because he has an institution that has hundreds of millions of dollars in deposits from minority communities, and he hasn't been able to find any way to put it back into those communities except, I guess, through finance companies in Atlanta. But the government should give him an incentive if it was going to do something to put that money back into the community. Well, it seems to me that's like feeding a fox who's eating your chickens more chickens so he won't eat as many chickens as you have. And so I would be against using this to give a carrot to those institutions who have yet to demonstrate the capacity or the willingness or the inclination to get involved in this business in the first place.
The only thing I'd like to add is that I don't want to let big banks off the hook. And my only one of my concerns is that with all the emphasis on starting new banks, that we won't be encouraging banks with the resources to do what they should do.
I guess I would remind us that there are a number of institutions involved in community development finance that aren't commercial banks or savings and loans or whatever, that there are a lot of intermediary institutions out there lending in a variety of lower income areas, and I think it's going to be interesting to see what role evolves for them as time goes on also.
Any comment?
Just one thing. If the community development banking activities from this administration come under HUD, forget it.
And with that succinct comment, we'll move to the floor. Why don't we start here on my right, if you'll identify yourself and your affiliation and then ask away.
Okay, my name is Amy Perlmutter. I'm a mid-career student here at the Kennedy School. And this is a question, I guess, for all of you, if you'd like to answer it. Where do you think that the role of foundations fits in with banks in community development?
Who would like?
I think that's an excellent question because many of the foundations, I'm sure South Shore found the same dilemma. I've made many a presentation to foundations and to corporations about investing in our bank or investing in the inner city. And the response I get is that, well, the people who would consider your proposal are in either our corporate philanthropy area or it's in our grant making area. And we only give money to nonprofit institutions. If you want us to invest, then you have to meet the same hurdle that we use for new razor blades or new photographic materials, or you have to meet the hurdle rate that our investment advisors create on competitive investing. So if you're a fledgling, if you don't meet those screens, either you're wealth creating and can outperform everybody else, or you're in a fairly narrow field, then it's very difficult to raise money as Henry said, as something that's going to be sustainable and profit making. I think foundations, and one of the things that could be done with the Community Development Bank laws or legislation, is to make it easier for foundations to make program-related investments and change the tax law that would not be as tough on them for making some investments. Right now, for a foundation to make an investment in a profit-making organization, they have to pay the lawyers more than the investment sometimes to figure out a way to do it. And so I think that getting foundations to invest, because some of the dividends that come out of these type of investments are longer-term infrastructure dividends that the whole society gets, not the individual investor who's looking to build wealth.
Any other comments?
Yeah, I would just add that if the Shore Bank would not have survived if it had not had access to foundation program-related investments. If you looked at a proportionate, at our capital accounts, you would find a disproportionate number of foundation investors. But the market, the need for development institutions is far, far greater than the amount of capital that's available in the philanthropic community, and any strategy cannot rely only on that market.
Let me go to the left side now.
Yes, my name is Charlene Lee, and I'm at the Harvard Business School. And my question is, most of the funding in the community banking that's going on has been mostly in the housing area. And you've all mentioned a little bit about the enterprise development. My impression is that that's fairly difficult to develop, especially in smaller loans because the transaction costs are so high. My question is, how have you measured the demand for these smaller loans? What is it actually, and also what is your participation in that in terms of how many loans you're getting to make?
In fact, that's one of my pet peeves is that when we talk about economic development, particularly in minority communities, gradually people shift to low-income housing and micro-enterprises. That's not economic development. That's a make-work program, or it's a way to warehouse people in poverty. In fact, my first project that I financed, thinking that I was really applying my banking skills, was a low-income housing project in Rochester that Saul Alinsky, Fight Inc. had put together. And it's probably the worst thing I've ever done in banking when I go back and see the end result of what I helped create. But at the time, I thought it was the best thing. I thought I had really begun to change the community, to make a contribution. I think that the focus of these community development banks should be no different than any other community. People want capital coming into their community. They want places, decent places to shop, to buy groceries, to buy drugs. I can't understand when 30 to 40% of the people who buy movie tickets are minorities. There's one or two cinemas located in urban areas throughout this country. I can't understand when most people have at least food stamp vouchers, and we don't have people in our inner cities going hungry. They have ability to buy food where you don't have supermarket chains in those communities. When most people have Medicaid or some form of ability to buy prescription drugs, you don't have pharmacies. So there's demand and capacity. Now, what a retailer told me, a white retailer told me that, Ron, we have a limited amount of capital. It's easier for us to build a supermarket in a white community adjacent to a minority community because the white people will continue to shop there and blacks will get in whatever they have to get to go shop in this area. And so we get two markets. Whereas if we located in the inner city in a black community, we'd only have the blacks that would shop there and whites would not go into that area because of fear of crime and the rest. And so those are the issues that we're dealing with in terms of a lack of investment in these communities. And I think it has to be investment on the same scale as the investments we look at the Somerville or Quincy or other working class communities.
I'd like to add, when we set up First Community Bank, we were very deliberate in setting up both a retail and a lending arm. And the retail side of our business supports the lending side because we know that these small business deals are time-intensive, high transaction costs, but our unit as a whole works. So the retail side supports the lending side. We have 5 lenders in Upham's Corner. We have the deals, I call them the deals from hell. They take 14 months to 2 years, but we are committed. What we try to do is bring in all the layers. We either work with the SBA or we try to take a leadership position in creating new intermediaries, or we'll do a deal with Ron. I think all of us share this passion for real community revitalization. I think there's a lot out there with affordable housing lobbies, but I think the emphasis needs to shift to meeting the needs of small business. What I'm hearing now, and it's something I don't have an answer for, is how to provide capital for startups. I've heard that in Hartford last week and Dudley Street this week, and I don't have an answer for how to, lend to startups.
Could you clarify for people what you mean by the retail side versus lending?
That's my branches. I have 12 branches that provide all of the services. We were fortunate that Bank of Boston had not left the inner city. We acknowledged the reality of redlining. That's the first thing that we did. We weren't doing all that we could, but we were still there. So we had a physical plant that we could grow, and we put the products together, so it's a growing business. And that side supports the much tougher side, which is small business lending, middle market lending. But the unit as a whole works.
I'd like to add to that I think that one of the most profitable areas of activity at South Shore Bank is SBA guaranteed term lending. I think we do more of that than anyone else in the city of Chicago. It's a very effective program, but in my opinion, it is one product on a very broad spectrum from self-employment to mid-sized manufacturer financing needs, and has to be supplanted by non-regulated bank credit and information services all up and down the chain of businesses who differ by experience, size, sector, et cetera. So that I think you're correct, that it's a very difficult business, enterprise development.
I think when we talk about business development, we have to do some layering, because there is small businesses which will always stay small, and they're kind of lifestyle businesses, and they generally don't require much equity. They need some loan. The equity comes from the mattresses of families and stuff that come out and help it. And those will prosper. They'll make a nice income for a small number of people. But if you're really talking about enterprise development, which are those businesses which will begin to employ a number of people in the community, and by that I mean more than 10, I mean 50 to 500, that generally requires some kind of a venture equity. And it cannot get started on bank loans. And the banks can help with the SBA loans on what that first year I talked about, but the banks can only come in after there's some equity investment for the enterprise development. And we have not solved the issue of how do we do minority enterprise development. And that's, and it's not only minority, it's rural and what have you. That's another issue.
Okay, on the right.
Hi, Ari Goldfield from Harvard Law School. We had a question for Mary Houghton. Has your success in redeveloping the community in terms of its housing led to any concomitant development and enterprises going on in that community at the same time, so that get people, in good housing, get them some equity, and then build a nice neighborhood, and then the businesses come up? Has that happened at all?
No. What has happened is that large numbers of residents have gone into the business of rehabbing housing, and they've been able to generate wealth and expand their rehab activities. So that's a very viable industry sector, housing rehab. The natural economic area, however, for small business growth in the area is probably bigger than our one neighborhood, which is primarily retail strips, and retail strips cannot compete, and so no smart person really goes into those businesses.
On the left.
My name is Joe Sternlieb. I'm an urban planning student at MIT. My question's for Gail Snowden. Ron Homer mentioned that his is the only bank that's a net importer of capital into low-income communities. I'm wondering if that's still the case for First Community Bank as well. If you strip out some of the very big deals like the $26 million in Roxbury, are you also a net exporter from low-income communities still? And if that's the case, at what point do you see tipping to become a net importer?
Ron's been at this a long time, longer than First Community, but that is our goal. In the past year, with the Bank of Boston's announcement of the original $3 billion credit initiative, now $6 billion, some of the things that were getting in the way in terms of credit standards have been loosened up. So since last May, we've been doing a lot in terms of making actual approvals and closing deals. But it is our goal to have the credit flowing within our community. We're trying to figure out a way to more closely link what we do. So I'd like to come up with, and there already exists, some kind of a socially responsible CD that we could then put into a project, whether it's the Grove Hall Mall or whether it's Jamaica Plain with trying to get a supermarket. And I'd like to more closely link those two activities.
Hi, I'm Bruce Goldberger. I'm at the law school. Most of the panelists who represent banks, I think, mentioned that you see education at least as much as financing and writing loans as your proper role. And my thinking was that that's probably because you just don't have all that much money to lend, as well as the fact that you want to raise awareness that the banks are out there for people in the inner cities to approach and get loans from. So that brings us back to Mr. Morgan's point that it's the large commercial banks that need to move more into this area because they are the ones who have more of the funds. And I'm wondering what's needed to make them see community banking as a profit center and not just a cost center. And a second question is, not really related, but a second question is, what do you see as the proper role of groups like the Enterprise Foundation and LISC?
Who would like to?
I'm going to take a part of that. I do have plenty of money to lend. I can lend within my department up to $5 million. But what we find is that we're dealing with an inexperienced borrowing customer, and that's why we do a lot of what we call technical assistance, or we send people to the Massachusetts Minority Enterprise Investment Corporation. This is a two-way street. The borrower has to be willing to invest some of himself or herself in doing a business plan, about thinking about collateral, if there is collateral. A lot of people just want to come and say, I have an idea, and you give them a check, and it doesn't work that way. So in terms of my bank, we're trying to bring people into the banking system, but it's much more complicated than I thought 3 years ago. It's not as easy, and you have to bring people along.
See, I would differ with your first premise, that I don't think the constraints on, in fact, minority banks throughout the country run about 40 or 50% loan to deposits. So that means they're nowhere, they should be up 70 or 80 if they wanted to maximize their profits. And so it's not a capacity problem. I think that I look at banks as information networks as well as loans and deposits. Loans and deposits just happen to be the tools that you use where you're matching someone who needs money and someone has money, and you're putting it together and you're getting a spread in between. And when we say that we need to educate, that is, you have to provide information as to what in the community as to where good investments lie, what the opportunities are, what opportunities are there to export goods and services out of the community, what some of the demands are, linking. I mean, can you imagine a community that's isolated and has no relationship to the healthcare industry, the defense industry, the computer industry, the large-scale state government, where they're not purchasing any goods? There would be no community in the Commonwealth that could survive economically cut off from those drivers of the economy. But the black community is essentially cut out. Healthcare industry is not spending money in their community. The defense industry is not running around putting new plant and equipment and spending money. So you have a situation where the community has been disenfranchised, not just because of capital, but lack of opportunity, lack of access to the information, lack of access to where the deals are actually be formulated. And that's one of the goals of whether it's community development banks or other intermediaries, is to provide the linkages between the community you're trying to serve and the broader economic drivers for the overall economy.
Could I try that? I think a major problem is that bankers have forgotten how to lend. I think that there needs to be a massive education of the major banks on how to make credit assessments in the community. I think when we took over South Shore, we had the conventional lenders, and we had trouble making loans until we developed a lot of ex-PhD students from the University of Chicago who learned to become bankers, who came at it with a non-banking view of the world. And I really think that with the easy credit for big loans to Keating and all these other BCCI types of things, people have forgotten how to make the small loans. And I think it takes a major, major education on the part of the large banks to acknowledge that they don't know how to make those loans.
How much of that difficulty in making these loans is a product of the regulatory climate, or is it not? Because certainly when you talk to bankers who aren't talking about community development lending, they will always talk about the regulatory zeal as a problem in making small business loans.
If the banks use the criteria that they use in making loans in the inner cities, in their general lending practice, they would never have a regulatory problem. In fact, I just got through with an FDIC exam, and we really, they look and marvel at us and say that when they look at it, if they took the blinders off, they say, gee, you use because we don't do spec office buildings in Roxbury. Okay, and you don't do, you get takeouts, you get cash flow, we're cash flow lenders, we're proven track record, to me, the regulators are not the problem. I go back to Henry, I think it's a problem of people are afraid to make decisions about people they can't relate to, don't know, don't necessarily trust, and in areas they wouldn't want to walk in, much less sleep in. or have their money in. And so you have these barriers, and I think we have to admit that there are barriers between certain parts of our society and other parts, and that those barriers, whether they're cultural, social, perceptual, have to be broken down, and money doesn't go through those barriers. And so somebody has to be in the vanguard of bringing money through those barriers, because some of those same barriers are put up there because the lack of money is what creates those barriers.
Right, I completely agree with Ron and Henry. I wanted to try to speak to your last question, which is how could you get the large banks to be doing dramatically more than they're currently doing of this kind of business activity? I think that you have to start with a recognition that the transaction costs of this kind of risk assessment, at least in the early years until you find market niches that are profitable, that the transaction costs make this lending, as Gail has said, less profitable or not profitable. So that any way in which you could provide financial incentives to the large banks that they could earn profits from that would offset the genuine costs of small transaction size, innovating risk management, might actually get their interest. It would be a carrot as opposed to a CRA stick, but it would have to be real financial incentives, real money, and there would have to be real performance that went along with that extra privilege.
Does greenlining meet that criterion? Right.
I'm not, Gail would know better than I whether it holds the promise for enough financial return.
It's just one more way, I think.
I think part of what's happening also is a psychology that's developed over the last several years, and there's been this sort of march towards conformity in terms of lending. And certainly on the housing side, I think it's been driven by the large secondary markets to an extent. And psychology has developed that that's the safe kind of lending, that's the recognizable kind of lending. And it's difficult for the institutions, I think, to step back and look at the deals on a more individual basis rather than looking at some sort of model that supposedly gives you some kind of security as a result of conforming to that model. The thing that has really been fascinating to me in terms of looking at the experience of the Federal Home Loan Bank with the affordable housing program in particular, I mean, which is in fact housing, not economic development, but is that the deals that work are the deals that are really constructed locally. I mean, they respond to the local situation, the peculiarities of that situation, the people who live there, their own individual needs, and that, I mean, Henry alluded to it in terms of, you know, give this initiative to HUD, and you probably killed it early on. And I think that one of the key ingredients is finding a way to keep those kinds of decisions at a local basis, as local as you possibly can, and for us to begin to break these chains of conformity that are really tying us up in terms of the lending that we should be doing.
In fact, I think that while the large banks have a role to play, and I don't want to denigrate that, I think that relying on the large banks to the solution to the problem that I'm talking about is like trying to rely on IBM to have recognized the PC market, or GM to recognize the need for smaller cars when they were selling all this other stuff, and Sears to recognize that there was a need for a Walmart or someone to do something different. And it's just hard for those institutions when they're focused on market share and going to the next state or to the next region or international and Mexico, et cetera, to focus on what's happening on the corner of Geneva Street and Dudley and Roxbury, and to think that they're going to put their energies around that, the same degree of energy when they see these other returns other places, is not, to me, not realistic. And I think that it costs more to make a decision about a small loan, particularly if the decision maker is 7 levels up and has never been in the area that he's making a decision. Now, I don't find it to cost a lot to make a lot of these decisions, because usually we have someone that comes in and says they want to borrow X number of dollars. We ask, do you have your statements? They have the statements, and they look at it, and we say, you know, we know the person generally, or he's 2 phone calls away from somebody we do know, and it's yay or nay. And so I don't think if you have an efficient way of getting the information and you understand what you're doing, some of these decisions are not as hard to make. Now, you do have, I was talking to the president of one of the local banks, and every industry that we lend to, they say they don't lend to. Like I talked about architects. Oh, we don't like architects because they're service industry. Well, that's what we had. I talked about restaurants. Oh, we don't do restaurants. They're too risky. Well, if you don't do service industry and you don't do some of these small shops, we don't do brokerage firms because it's too competitive, et cetera. When you got through the list of, now I do know that somewhere down the line somebody's making loans in this shop around that, but they make an individual decision. But when you get to the large, decision maker, they're going to rule out all these things where there's risk, and in terms that means they ruled out 80% of the entrepreneurs that are in some of these communities.
Gail, would you like to comment on this?
I think one of the things that's been sort of fascinating about First Community Bank is that we've been able to break the paradigm for what banking should be. And paradigm is a word that I just learned 3 years ago. I didn't know that I was doing this. But I came in with senior management support. I came in as an outsider. My goal was to look at what was working right and then to be very creative and innovative and do things differently. And it was tough at times because you're talking about a huge bureaucracy. But now people are saying, well, how come First Community Bank can win this incentive program or do this and that? Is there something in the way that they are managed that other divisions of Bank of Boston could learn from? So I think that that's very interesting. I've read about these little bits of companies, little pieces of companies that develop new ideas, whether it was at 3M, where they developed the yellow stickies or whatever. We're sort of that in Bank of Boston. We're a laboratory. And people find that fascinating, and I attract so many people. I can't possibly hire all the people who don't tell other people in the bank that they worked in the Peace Corps or that they did whatever, but this is the place they want to be in the community, tying what they do so that they can see change and that they can be a part of it.
Hello, my name is Monica Brand. I'm also at the business school. I work there. I first want to say that I think the work you do is commendable, but I had a question more on your opinion about the government's role in this. You alluded a little bit more in negative terms versus HUD and as well as regulatory burdens that government places. Do you see a constructive role either in terms of training, which some of you have alluded to, but I'd like to know more about business training that you do, especially in these areas that don't have a lot of exposure to it, and do you see some kind of government role either through SBA or some constructive role the government can play?
Yeah, I see a role for the government in helping. The limiting factor for our bank, and I think similar small banks in general, with rural banks, community banks, which I think are needed in the country anyway, is that the capital invested in it has to be very patient and is often illiquid. And while it can grow on paper to create a market, because there's just not a lot of people looking around to invest in a bank in Walla Walla, Mississippi, or one that specializes in Roxbury, and so you have a limited investment pool. So to the extent that there can be investment tax credits where the person can leave their capital in over time but get a return on the capital through writing it off, very much like the low-income housing tax credits, and that way also it enters what Mary talked about, competition where only those banks that can attract private investors and assure them that their capital would be at least safe and preserved could get it. You could even have a competition around who could get the investment tax credits, just like the low-income housing programs. So I think that's one way. It could be capital gains relief, relief on when you eventually do sell it. Could even be a secondary market for some of the stock in the banks. So there are a lot of ways that the government could work, primarily I think through the tax code and through enhancing the yield on the investments or making them liquid, which would be most helpful.
Other comments?
Well, I'm not in favor of large government programs, even though I am a strong Democrat. But the issue for me is that I think government should be enabling, that what a government role should be one which helps identify problems and helps enable the private sector to solve the problem. So that to the extent that there are research capabilities in the federal government and some broader visions of what goes on. I think they could set a climate which would enable the private sector to move in and solve it. So maybe they fund experiments, but not fund programs.
Yeah, I would add two thoughts. One is, if I care about anything, I think it is that as a society that we recognize that permanent development institutions are needed over the very long term in communities, and I think that the government is currently playing a very valuable role in raising a public debate about whether we need something as serious as a bank or a bank holding company in order to begin to really be focused on these problems. That's very valuable. Credibility. And then the second thing is, I think that the startup costs of creating these development institutions are almost, they defeat most efforts. And I think there's a role for funding the front-end costs of the creation of these institutions and the training costs that won't come from the foundation sector or from private investors.
I suppose this really does get to the heart of the government participation issue, the funding side. There is $400 million in the Clinton budget proposal for community development banks. It's not clear just what that would do, whether it would be a direct equity investment, or some others have discussed the possibility of another government-sponsored enterprise like the home loan banks to fund in some way community development banks. I wonder how all of you feel about that.
Let me comment. I don't know how many of you watched the December Economic Summit conferences in Little Rock, but Mary Houghton and her Chicago crew, led by Del Simmons, the president of the MacArthur Foundation, really triggered the admission by, maybe you can tell a story, Mary. So it wasn't $480 million, I think it was $86 billion which could be released. You triggered that number, Mary.
The point was that somebody asked, with more incentives in the regulatory system, what more could the banking system do in order to create small business investment? And the man who was the head of the American Bankers Association said that $86 billion would be released in the system easily if regulatory constraints were eased. So I think that Henry's point is probably that the $400 million is the yeast that starts a process, and the point is the leverage that can be started, not the amount of government financing. Senator Bill Bradley has introduced 8 bills into Congress on to support a very comprehensive urban poverty approach, and I think the total cost of his program is $1 billion, which he points out is really minuscule.
Yes, $1 billion is minuscule.
I hope that we don't end up making this all terribly complicated, but I'm sure that we will. I mean, but it seems to me, again, to carry an analogy, I guess, from affordable housing, that there was a time when we sort of spent searching for the holy grail of low-income housing produced without subsidies. And I think we all got to an understanding that in most cases, if you're serving people with very low incomes, that there is a need for subsidy. I mean, the problem with low-income people is they don't have any money, and it makes it very difficult for a project to work on a strictly market basis. And I think a lot is probably the same, the analogy holds for community economic development. And I certainly agree with Ron and that you want to do just as much as you possibly can from the private sector and make the market appear as a normal private market as much as is possible, but there are areas where government involvement can certainly be helpful. And it seems to me that the more direct that involvement is, that probably in the long run, the better off we're going to be. We're going to be able to recognize it, we're going to be able to count it, understand what it is that we're doing to ourselves or not doing to ourselves. And I fear that we may come up with some very complex ways of funding this, things like the low-income housing tax credit for housing, that accomplishes a goal, but at quite a cost in terms of of all the additional costs associated with it, the legal fees and everything else that make that kind of approach work. So from my point of view, that there clearly is a government role, but it doesn't need to be, terribly obscure as we pursue it, I guess.
One of the things I want to address this issue about government and their role in the economy. If the government created the defense industry because we wanted B-1 bombers, nobody else wanted to pay for them other than the government's going to pay for them, and not only bought B-1 bombers and F-15s for us, but for other countries too, and created a whole industry. And now we have people at Raytheon and Lockheed going back to the government for conversion so that they don't throw out all these engineers who spent their life learning how to do bombers into the street and they can do something else. The healthcare industry, we paid for the healthcare industry. We have third-party reimbursement and Medicare and NIH grants to pay for the healthcare industry. We have one of the best healthcare systems in the country. We have one of the defense industries. If we're going to address the issue of economic development in our cities, and I don't think you can have a strong nation without strong cities, and address some of the problems in these areas, it's going to cost some money. It's not going to be solved because everybody adopts a new family value structure today overnight. It's going to cost some money in terms of conversion, in terms of retraining, retooling, bringing new people into the system, and you can't start on the education system in kindergarten while families are in disarray and while communities are in disarray, because you'll just be pouring, bad money after bad, or good money after bad, if you try to start that process without dealing with the whole. So $400 million, which can be leveraged in a lot of different ways to me in addressing what probably is one of the major threatening areas of our society moving forward today, is relatively minuscule, and it's less than we're going to do for Russia, for $1.6 billion.
My name is David Wallach. I'm a student here at the Kennedy School. Earlier, Ms. Houghton, you mentioned that this new network of community development banks should include whoever has the greatest capacity to lend, and Mr. Homer, you added we should put the best players on the field. Yesterday, there was an article in the New York Times about the Central Brooklyn Credit Union in Crown Heights, and a recently chartered up-and-coming community development credit union, one of the alternative institutions that Mr. Parrish had referred to. Here's an institution that could really leverage an infusion of capital, yet they don't have the track record now. Do you see a role for an organization like this in Clinton's network of development banks?
Yeah, I didn't mean to say it should only be people with 20-year track record. I'm talking about just like venture capitalists don't necessarily finance just people who've been in the business for 20 years. I think I'm talking about looking at people, their background, their business plan, their contacts in the community, their basis of community, other investment that they can leverage it with, and going through a process where there's a hurdle that people have to get through in terms of getting both community support and investor support. So precisely, I would say that, I don't know the people involved in that credit union. It's my old neighborhood where I grew up. But I think that they would be available to compete like everyone else. And the entrepreneur, to the extent that people are interested in community development, all I'm saying is let's establish criteria as to what community development means. Let's make sure it's the right criteria, it's one we want 15 years down the road that we want to pay for, and let's try to make a value judgment as to who are the best people to get there. Is it Chad Gifford? Is it Joe Blow? Is it Ron Homer, et cetera? Let the market make those judgments.
I would only like to say that I don't think that this is only about lending. I think that credit in and of itself is just not going to solve the problems of communities that need equity, that need development, that need initiative taking, that need subsidy that comes through not-for-profits. A credit union like the one that was described in the New York Times could, if it wanted to, could develop partnerships with local not-for-profit CDC And there's a credit union in North Carolina that has created an equity venture fund and some affiliated tools. So I think that one of the problems, the debate that's been occurring is that it's been defined as about loans. And I think that what it's about is comprehensive community development.
My name's Cinda Wall from the Harvard Business School. Peer lending is a model that's been quite effective in many countries overseas, and I was wondering what all of you think is the potential for that to work here in the United States as a way to get around some of the problems you all have brought up about collateral. It's something that no longer views collateral as necessary for loans. It addresses that issue creatively to come up with new ways for security, and also seems to address not just the lending but the community development aspect.
That's what the Small Business Fund here in Boston has some elements of it, not completely. And there's also a fund called the Working Capital Fund.
Right.
And in some cases, the loans that they want are only $500. So I think the peer system of lending, does work. I've talked to Axion. I'm trying to learn more about what they're doing. So it's another form that I encourage.
One of the things that people like to fight about the most is the proper use of scarce resources and whether or not resources should support long-term entrepreneurial development of individuals, which these peer programs do, or whether it should support employment-generating mid-sized firms will divide all previous groups of friends quickly. It seems as though we need both long-term strategies of capacity building, and we need now employment-generating strategies. And there is a genuine, serious question about how far resources will go. I would fight for both.
My name is Cliff Barber. I'm from the Harvard Business School. And my question has to do with community development banks, in particular Shore Bank. And one of the things that's been interesting in your comments, all of you, is that you've said that there's several models that the Clinton administration might consider for how they deal with the community development banking problem. But for right now, I'm going to concentrate on the fact that one of the suggestions is to have 100 community development banks. And one of the things that concerns me, I guess everything I know about community development banks comes from the press. And two criticisms I've heard about Shore Bank in particular is that one, you depend heavily on the socially conscious, quote unquote, for your funding. And the second one is that, and you addressed this partly, was that your returns to your shareholders have been lower than the average for a bank of your size. One of my concerns is the replicability and sustainability of a Shore Bank or community development bank, which is based on that model going forward. If you're depending on people like Mr. Morgan, I mean, how many Mr. Morgans are there out there who have these sort of socially conscious funds? The other thing is too, if you have 100 different banks competing for this pool of socially conscious funds, is it that you're arguing that pool of funds is going to increase in the future? And if so, do you think that's sustainable? And how will Shore Bank deal with that in particular, if in fact there are 100, if this new sort of model is put in place?
I think the competition would be great, but and maybe let Henry respond first.
My return in the last 8 years has been pretty good. My return in the first 12 years when we were learning wasn't very good, but I think we know enough now. Shore Bank earns 1% on assets. It's an acceptable return. All of our financial measures now are well above the average for all banks. There was a learning curve, and I think having gone through that learning curve, Shore Bank is a sound financial investment. We just got $7.2 million invested in the last month from the major banks in Chicago, and they see it not as they like CRA credit, but I think they had to go through their bank boards to see it as a sincere investment. I think there's enough money. I think more and more the socially responsible investors are growing. I think people are asking questions, and I think that's an huge untapped market.
I would like to just add that it has been very useful to the management of Shore Bank to have investors who expected it to perform on both public purpose and economic return criteria. And it has helped us to make an infinite series of difficult, complex judgments over the last 20 years. And I'm very grateful that we didn't have shareholders who wanted this quarter's return. Having said that, I think that institutions like Shore Bank are going to have to learn how to diversify their capital structure to include a broader range of motivations amongst shareholders. But the price could be tough if what you're trying to do is run a public purpose institution.
I think I should take just one last question since I was supposed to finish this up by 7:30. I'm going to probably miss that. So let me take one last question.
My name is Allison Lewis-Smith, and I'm a mid-career student at the Kennedy School. And I want to make a comment and then throw it open for discussion. I was impressed, Mr. Homer, when I came in and you were speaking about the need for having black professionals return to the communities from which they came from, and the whole issue as robbing that community of its talent. I remember when I started my practice 20 years ago in Central Harlem and in Jamaica, Queens, it was very easy to find dentists, doctors, architects, brokers there. A lot of projects that I worked on in the housing area, particularly affordable low-income housing, are now being built. The problem that I'm finding now in going back to Central Harlem when I leave Boston on my weekends is that we now have housing being built, we have condominiums being built. They're not selling because, just as you've indicated, it is almost impossible, and I can only speak from the New York market, to get loans for the service industry. U.S. healthcare has very few private physicians located in the Harlem community or in black communities. One of the things that we need to do is to make available, I think, these service loans so that we can stabilize these communities. And I think we should not just emphasize low-income families, but realize what actually makes a community. And I guess what I'm asking you is, what future do we have for those of us coming out of the Kennedy School, those of us coming out of the business schools, the dental schools, the medical schools, to reinvest our time and our dollars in the communities where we can possibly work or have our private practices, as well as live in those communities so they no longer become areas that we flee from, but they're places where we want to live. So I'm sort of throwing it out, basically picking up on your service industry, a component of, I think it was about 3 or 4 questions ago that you addressed.
Anybody want to comment on that? No?
Just a general comment, and a few others. One of the things I find very encouraging at this point that I guess I didn't expect a couple of years ago is that I think the dialogue really has changed. Again, I come at it from a housing perspective, but to viewing communities much more comprehensively than we did in the past, and really seeing them as networks that really have to include not only adequate housing, but social services, and very importantly, economic development, sustainable jobs and job growth. And I think just the shift in the dialogue that's occurred over the last couple of years has been very important. I know, just to personalize it, the Federal Home Loan Bank, I mean, the banks, I think, were sort of brought kicking and screaming into the affordable housing area to a certain extent. I mean, it was when the well-conceived FIREA legislation was put on the books. It wasn't necessarily with, resounding endorsement by the financial industry, probably. But I think what has happened in that is that people have become more sensitive to the opportunities that exist, the opportunities for good investment that exist in that area. And I think now what's happening is that dialogue really is being expanded, and we're finding ourselves at the Federal Home Loan Banks and a lot of our members paying a lot more attention to the whole idea of community economic development and not just housing, as was very much the case in the past. So I think that shift in the way this is being conceived at this point is an important first step, but still a long ways to go, obviously.
I just want to make a personal statement before Ron says something here. When I was at my 25th reunion last June here in Cambridge, my speech was on, my class was the class of '67, we were the radicals, and I was supposed to talk on civil rights 25 years later. Well, I had a terrible time because it was like a block. I couldn't think of anything to say. So what I finally said was that and this is very personal, this is taking off the Bank of Boston hat. I'm no longer willing to try to engage in dialogues around racism and the history of this country or what white folks need to do. And that personally I am what black folks can do and how black folks can get together and have these kinds of dialogues. So now, politically, I'm trying to put my dollars to politicians who support my views, and I'm trying to join organizations such as the Coalition of 100 Black Women, which is black folks doing stuff for black folks. And that's on a personal level where I am after 25 years of being in the struggle, that I can't wait any longer, that we have to do something for ourselves.
Could I say something before I want Ron to have the last word? I have 6 children and 11 grandchildren. The major factor about where they live are the schools. And I do not think that you can address quality of lifestyle for professionals who have children until we do something about the public schools and the community they live in. So we talk about community development, but I don't think those communities become livable until the quality of schools get up to what we want them to be.
Well, I think schools are one issue, but safety,
Yep.
Availability of services. Many people flee Harlem and Roxbury just because it's hard to buy a container of milk after 6 o'clock hour. They feel it's hard to walk down the street without seeing without being harassed. I think that the issue that you addressed is one I spend a lot of time thinking about, because I have this $80 million of assets that pays my bills sitting in Roxbury every night, and I wonder how good those assets are, and who's going to protect them and who's going to utilize them. I think 2 things I'd like to suggest. One, we need a shift in public policy and an orientation which I think the black community can help drive, in that no longer do we want transfer payments and money devoted to the pathology of our communities. Even the liberals tend to focus more on our pathologies than our strength, and therefore every program that's designed, quote, for minority constituencies are designed around this type of pathological appeasement. And I think we need to change that debate in terms of what we advocate for. Secondly, I think the whole area of affirmative action and minority preferences, which are controversial in general, need to be reshifted towards defining an issue that here is an undeveloped economy within our overall economy, and that by tapping into that economy, we will, one, address the pathologies, save the government a lot of money with these transfer payments, and pay off in the long term, and that we're willing to pay foot soldiers to go in there and do battle that other people really don't want to do, and that we're going to do that by paying for their services to go in and build the businesses and invest their capital. And that's why I think those incentives are worthwhile, and that's where I see the community development banks as being one of many things that we do. We have people like Colin Powell, who's head of Joint Chiefs of Staff, Ron Brown, Secretary of Commerce, Hazel O'Leary, Energy. We've made it individually, and there's no reason why any black person can't reach the highest levels as an individual, whether it's a president of a university or owning Beatrice Foods like Reggie Lewis. But as a total people, we still have the residuals of oppression and economic discrimination, and I think we've got to develop our ideas around building institutions that can address that for ourselves.
Ron, thank you very much, and I want to thank all the panel for what has been an absolutely fascinating discussion. And finally, I just also would like to thank David Brickman and Heather Campion of the Harvard Real Estate and Urban Development Forum for organizing this evening. I believe there is an opportunity to speak with the panelists down here if you'd like to take the time.